Hey, real estate rock stars, welcome to the whole enchilada of real estate investing, the only podcast that serves up the full feast of street smart strategies to build wealth and take control of your financial future. I'm Lou Brown, and I've been in the real estate game since 1976, so I've learned how to make the whole plate worth it. Each week, I'll be dishing out creative financing hacks and proven systems that help investors build multi-million-dollar businesses. No fluff, just the good stuff, straight from the source. Ready to dig in and start making deals? Let's get to it. Welcome, everyone. It's Lou Brown with another edition of the whole enchilada of real estate investing. And I'm so pleased today that we have, just an amazing expert that has some great things to share with you today. Chris Seveney, tell us about yourself, where you're located, and what you do.
Yeah, first, Lou, thanks for having me on today. I am located just outside the nation's capital, Washington, D.C., in Northern Virginia. I am married with an awesome wife and two wonderful kids. And what I do is unique because most people don't know you can actually do what I do.
I like things like that.
Yeah. So we buy defaulted mortgages from hedge funds, banks, and other institutions. So a lot of people may have heard of private lending and so forth, but most people didn't know there's this whole market of buying distressed loans. And that is what we do.
So it's a funny thing. Some people want clean books. They don't want any kind of collection issues. They don't want to deal with anything. So they're willing to take a discount and have investors like yourself come along and purchase those at a discount so they can keep their clean books. Is that right?
That is 100% correct.
Yeah, baby. And so when you're able to come in and buy those mortgages from those hedge funds and the others that want those clean books, what kind of discounts can you expect to get on the unpaid principal balance?
Unfortunately, the discounts have gotten a lot lower over the last few years as competition and increase in inflation. When I started 7 years ago, we were buying stuff at 50 to 70% discount. So it was basically like a Kmart blue light special type deal. So if people are old enough to know what that is, you know what it is.
I know what that is.
Yeah, but today's world, things are typically being sold at about 25 to 40% discount. So margins have gotten tighter, but as we're recording this, we've seen a little bit of influx in some of the markets and certain things going on with the economy. And typically when there's influx in the economy, typically discounts will increase again because there's more assets that could potentially hit the market. So straight supply and demand model that we're anticipating more supply, which will equate to maybe some bigger discounts coming down the road.
So earlier you were telling me a little bit about your background, and I think to give a foundation to what you're teaching us today, tell us a bit about how you got into real estate and what you've been doing over the years.
Yeah, so I got into real estate. I've always been in real estate. When I went to school, I went for civil engineering. And my last year of civil engineering, I was like, I'm going to be a structural engineer and design buildings and bridges. And then I realized, do I really want to sit in an office all day just designing the size of steel? And this is right around the time when the internet was getting launched and they started creating software that could do all the calculations for you. And I'm like, this doesn't seem great. As part of the engineering program, they also had construction management, which really takes a lot of what you learn from engineering and problem solving and relay it. So that's what I started out with. And I joked I was a white guy in a white shirt and tie on a construction site that looks like they're doing nothing. So that's what I did for 15 years, but you actually do a lot of work.
Yeah.
And from there, I ran a multifamily division for a local real estate company. I ran real estate for a family office as well before going out and starting my own company.
Wow. Yeah, that's definitely an amazing thing. So when you were with the family office, what did you do there?
So they were I'll use the term hold investment company. They've owned real estate in the Washington, D.C. area since the 40s and 50s.
Wow.
And yeah, stuff that you could only wish you owned.
Called sweet.
Yeah, they had a one campus right on the border of Maryland, DC. I think it was like a 25-acre campus that had 1,200 apartments, office, retail, and other. They were doing a whole new master plan on that. So when I got there, we were building a 16-story brand new apartment building, renovating some of the other existing buildings. And also, this is right at the beginning of COVID. So in a lot of the offices, what they're doing is upgrading a lot of the HVAC systems and building a lot more conference centers within the office buildings and some other types of office space. So doing office, retail, residential, which is pretty much what my bread and butter has been throughout my entire career.
Wow. So that's definitely a fabulous background, but so different than what you're doing now. How did you transition from the one to the other?
Yeah, I blame my wife. So, and
Well, it's usually the guy that gets blamed, so that's a good thing.
yeah, and hopefully she's not listening. She's upstairs working from home today too now. But I joke about that, or actually, I thank her in reality. We're in the DC area, heavy competitive area, and had some rentals, and we were buying rentals that needed work, rehabbing them, refinancing them, and going off to the next one. That's fun and great to do, but try doing it with two little kids.
Oh, wow.
So it came to a point after we did two or three of them that my wife is okay. This is just too much. It's just too much on us going on. Basically, let's slow down. And typical guy, it's slow down. I don't know what that means. So to me that means let me find something else to do or what rabbit hole I can go down. And that's when I stumbled upon note investing. And basically, what I loved about it is we're buying defaulted loans which need problem solving. How can we try and keep this person in their house and get them on a repayment plan? So there's problem solving, there's analytics because you're dealing with numbers all day long, and there's finance because you're dealing with money. So everything that I was always doing, and then some occasions you do have to take the property back, which again, I have experience in that real estate. So everything I was doing, it was just ancillary, or I used a lot of the prior skills that I had from my 20 years experience to implement into the note investing.
Except this time, instead of doing it for other people, you were actually doing it for your own account, right? So
Yes.
now you could take all those skills that you could build up and now do it to build your own business. That's quite awesome. So your first foray into that world, how did that look?
It was scary. Typical engineer of basically waiting for the perfect opportunity. Indecision's the worst decision. I spent 6 months researching, studying, educating myself, making sure I understood everything that could happen. And as in life, you're always constantly learning and educating yourself. But it took me that amount of time to be comfortable to understand, okay, I'm ready. And when I got ready, I went and I bought a handful of assets that were in different phases of default and started working those out by working with the borrowers, some were in bankruptcy, going through that whole process. And really, the biggest learning curve I had was understanding how slow the space is in regards to you use a servicer who really is like a property manager. How long it takes them to put it in their system and then make phone calls and everything else. Being a type A of why isn't this like moving at the speed of light? It's
Right?
moving at a snail's pace. So that was really one of my biggest initial learning curves up front was between the servicers and attorneys. They're all smart people, but they move at their own pace.
It's so true, and definitely I've lived that. And of course, I've done some note investing as well. So we'll have
Mhm.
to compare some notes for sure. But it's been a fun process. So you started with single family investments, meaning single notes that are secured by single family properties?
Yep, and that's primarily still what we're doing. We see some commercial opportunities and other things, but we feel like we have a very good competitive edge in the single family space because we know the space. Some of our borrowers are owner occupied that a lot of other companies don't want to deal with because you have compliance issues, licensing, and other things that reduces competition. And we feel we built a very good niche in what we do. And that's one I think differentiators is us as a company is we're focused, and that's our primary focus. I see a lot of people, one day they're doing a debt fund and buying notes, the next day they're buying mobile home parks, the next day they're buying multifamily, and the next day they're into crypto, who knows what. For us, it's, hey, we're a note company and really try and stick to what we're good at and be the experts at.
Oh, that's perfect. So definitely one of the great things that this business allows is there's so much diversity. There's so many different things you can do in this business. And when you got good at notes, how long, first of all, would you say that when you forayed into notes to becoming an expert in notes, how long would you say that took you?
I still don't consider myself an expert, to be honest. And it's
We're
been
always learning, aren't we, brother?
8+ years. I would say that it took me a good several years because you're always learning and like finding out new things. But it's something that, takes several years. And I'll share some stories where I have some people who started around the same time as I did, and they would go take like a weekend course here and there and think, oh, now I'm an expert. And I always use, again, I go back to my roots, the analogy of back in school where I could take a class on concrete and I could learn a lot about concrete, which there is a lot to learn, believe it or not, on concrete. And you could talk the talk after taking a course on concrete, but could you design a building, design a bridge? Maybe you could do a sidewalk, but outside of that, and that's similar to any type of investment strategy. Usually you get things at a very high level, and then you got to start peeling back the onion to understand the risks involved and everything that can go right, but also everything that can go wrong.
Amen.
And that's how I found my business partner actually was I was doing a webinar on how to lose money in real estate. And there were like 20 other people telling you how easy it is, how awesome it is, and everything. And I step up and I'm like, here's all the ways you're going to lose money. And my partner now at the time saw that and was like, wow, this person is just a straight shooter and tells it like he sees it. And at the time, she was on maternity leave, taking care of just had her second son. And we were just talking and educating her. And then I asked her one day, I'm like, hey, look, I need some help. You want to help me while you're, at home? And she's like, yeah, because I'm bored. So she started working with me. And then after about 3 months, she was crushing it. I'm finally like, how about we just go start a fund, go raise $100 million and really take this to the next level? And if you ask anybody that, they're going to be, after working with you for 3 months, they're like, okay, what are you on? And so forth. And first she's, yeah, whatever. And I'm like, and then she's talking to somebody else and she's like, oh, if Chris mentioned that, Chris is serious. And she's like, no, he's not. And she's like, you should probably talk to him. Of course I was. And then basically brought her on board and she runs now all my investor relations and has gotten us over 800 investors and gotten us to where we are on that side of things. So yeah, interesting how things can turn out for you.
So part of the secret sauce that you have is a lot of money, right? So you're able to go to the big players that do have inventories of defaulted mortgages that want the
Mhm.
clean books, and you're able to say, I got a lot of money, let's talk.
It is. So that is an advantage. And what I'll tell people is getting there was not easy. It took time, effort. But here's the one thing I'll tell everybody because everybody's an entrepreneur wants to wear as many hats as possible and think they can do it all. And I will tell you, I joke, I'm like, I hate people in the sense of I'm not a salesperson, I'm an engineer and I can talk notes all day long, but it doesn't fill my cup by trying to get people to invest. And there's other things that, as part of any company, you like to do and what you don't prefer to do. And I found people who are experts in what they love, the things that I wasn't good at or did not want to do. And prior to bringing on people, I had raised about $5 million. I bring on a team, and this was over a span of, let's say, 4 years. I start bringing on people. We hit that number in 4 months.
Mm.
So just show people, like, toss your ego aside, and then find people who can assimilate with, who have strengths that focus off of some of the things that might be your perceived weaknesses.
Wow. Wow. So just you yourself, and you are an
Yep.
entrepreneur, and you said I can do it all, and if I start bringing some talent on board, I can teach them what to do, and I can have a much bigger benefit from it, because now you've got 800 investors. And how much have you raised?
About just over 42 million.
$42 million. Oh,
Yep.
yeah, baby. That is beautiful. And now you can go to these big players and say, hey, we've got money to invest. Let's take a look at what your defaulted mortgages are. And we'll be more than happy to see if we can come to some numbers that we can agree on, huh?
Exactly. And for example, tomorrow we're putting in a bid on a list of loans that for example, we just had a loan that we took the property back, we renovated it, we sold it, and netted close to 1.8 million on that property. We raised $2.5 million last month, plus we got another several loans paying off this month as well. So by the end of the month, we're going to have $5+ million, and tomorrow we're going to be putting in $5+ million in bids that, on assets that just rinse and repeat that cycle.
Now, most of the notes that you're purchasing, where are they located?
They are all over the
All
place.
over the country.
Yeah. And again, we typically don't buy in New York, or we might have an asset here and there in the Northeast, typically nothing in the Pacific Northwest. Alaska, Hawaii, Dakotas, Montana. We don't see stuff there. Most of the loans are Pennsylvania south out towards kind of Ohio down to Texas and across kind of that southeast Midwest corridor. And then we'll see a little bit in Arizona and Florida. I'm sorry, Arizona and California as well.
California. So, one of the things that you're looking at is can play in certain states because they've got such advantageous laws that can make it so easy for people to hang out in the house and not pay you for an extended period of time.
Yeah, so New York, for example, is one of those states. So we typically don't buy anything in New York because it's painful to go through the legal process in New York. Believe it or not, a lot of people think it's a red versus blue issue, and it's not actually. For example, it's easier to foreclose in California than it is in Florida, where
Mm.
it's easier to evict in Florida than California. So certain states are very peculiar in regards to foreclosure, and others are very quick. And there's a process. It's called judicial or non-judicial. Judicial means you actually have to go in front of a judge in the court. Non-judicial means I send Lou a letter saying, hey, you got 30 days to bring your loan current, or I'm going to publish in the newspaper I'm selling your house. And literally, we're in basically April right now. If this was Georgia, I might be able to get your house sold in the first week in May or maybe latest June. Some states are really quick, others can take years.
Yes, so true. And definitely anybody looking at defaulted mortgages, you need to pay attention where that property is located. We are in Georgia, and we do enjoy that 30-day foreclosure span. However, yeah, any non-judicial loan can be made judicial through lawsuits, so it
Yep.
can extend out beyond that for sure. But these are the tricks of time, and definitely making decisions about what works and what doesn't. Now, of course, you really don't want to go through the painful foreclosure process, do you?
No, we typically don't. And as of, I say, this recording, we probably foreclose on 10% of the loans. And in the most part, because we're buying them at a discount and the way we underwrite the loans, it truly can be a win-win situation where we can work with a borrower. Typically, what we do is we do have an attorney send a letter at the outset because these loans are 3 to 4 years behind. This isn't like somebody who missed one or two payments. And so an attorney letter usually gets them to the table to have a conversation. Then we'll look to try and get them a down payment. Let's say they're $20,000 behind. We're not asking for 20,000. What can they bring to the table? And then what can they afford for a monthly payment? We look at that as well to underwrite it. And then we put them on what's called a trial payment plan, which is basically a payment plan on training wheels. If you do this for 6 months, Then what we'll do is we'll bundle all the past due, late fees, accrued interest, and we'll roll it into kind of a new loan balance and then re-amortize the loan for you. And then it will show you as current. Your payments will basically probably stay the same, but it also now on your credit report will show that your loan's current, which will let you help build your credit back up.
Oh man, that is a beautiful thing. And definitely it's a win-win. We are certified affordable housing providers, and what we do is help deserving families end up with home ownership regardless of credit or financial background. And so in our world, we're working with folks that might have had a detour in their past, some kind of issue that,
Mhm.
hey, we're trying to help them get back in the game, so to speak. So
Mhm.
definitely, if we can help people stay in a home, we're all into that and want that
Mhm.
to work out. Now, if somebody's just looking at defaulted loans and obviously they don't have $42 million, what kind of advice would you give it to somebody just looking at this and saying, hey, I might have an interest in this?
Yeah. So there's things I see a lot of people do that I say are right and wrong. It is a business, which is interesting because you can buy a $30,000 loan on a $300,000 house. So unlike traditional real estate, they need $300,000 for, you can buy a loan for 20, 30, $50,000. So it's unique in that sense. The downside to part of what we do is you are the bank, so you can't get financing to finance you buying a loan. So you basically have to use your own funds. Typically, I tell people who get into this space, try and do it on something that is an asset that if you had to take it back, you would want. Don't go, I don't recommend people start with like vacant land or like a trashed mobile home, manufactured home in Memphis, Tennessee. And no offense to Memphis, but hey, look, it can be some pretty rough areas that, can occur. So, really, baby steps in regards to getting into this space and just continue to educate yourself. But there comes a point in time where, hey, you got to rip the band-aid off and go buy it because that's the only way you're truly going to learn. It's like anything. Use the analogy of golf. I can watch somebody swing a golf club 1,000 times and think I know, but until you step onto that tee box and put the ball in and take that swing and hit it, completely different animal.
You
And
don't know nothing.
yeah, you don't exactly. And that's how investing is.
Yes. So there's those kind of people that are the entrepreneur brains that do want to
Mhm,
try to do it themselves. Then there's
mhm.
other people that look at you and say, why would I try to do that myself? Why wouldn't I go with somebody that's got the kind of background and experience you have? So tell me what that looks like.
Yeah, we see a lot, and again, we've got 800 plus investors who say, I don't want to learn this, I don't want to do this, but also understand we are an alternative investment that we're not correlated to the stock market. So that's a benefit. We don't have leverage. People in the multifamily space probably heard out a lot of issues in multifamily over the last few years because cap rates increased, interest rates increased, and then the valuations came down and they were underwater. We don't have leverage. Interest rates really don't impact us either because we're buying based off of a yield. So if a loan's, again, remember, the loans are fixed. So if the loan's fixed at 8%, we discount it to get to a number. If it's at 6%, we discount it more to get to that number. So your mortgage is fixed. It's not changing based off what's going on today. The main driver for us is really jobs. The more job losses, then the higher potential default rate. But even here's the interesting too. We're buying a lot of loans that are called 10 years old. So think about if you bought a
Mhm.
house 10 years ago, what did you pay for it? And your mortgage, what happens to your mortgage over time? It usually slowly goes down. But what is that house worth today? I can tell you that when we built our house, our LTV after completion was probably about 60% when we're done. Today, our LTV is about 30%.
Yeah.
I say that because when we're buying loans at that age, even if housing drops by 10%, a $200,000 house, say it drops to 150, the loan we're buying is probably only $100,000. Plus, we're buying it at a discount. Our investment to value in our portfolio is like 35 or 40%. We try and mitigate as much risk as possible now. I will be upfront with people. If you're chasing returns, we're not the type of investment for you, because I like to say we're the lazy river. If you go to a water park, you can go on all the fast rides or you can sit in the lazy river. We're the lazy river. We want to be slow, boring, hit our singles, hit our doubles, and provide 8 to 10% to our investors, pay them annually and pay them on a monthly basis, and try and be a set it and forget it, not be the roller coaster hair on fire.
So 8 to 10% is what your investors can expect to get, and you pay out
Mm.
monthly. Is that correct?
Yep.
Yep. So the fund goes in and buys at the heavy discount. The
Mm.
fund deals with
Mm.
all the fun
Yeah.
the non-payers, the foreclosures,
Yep.
but also the workouts, does all the
Mm.
heavy lifting, and the
Mm.
investor does nothing except put up money. And then you are able to take that money, go negotiate the deals, and the
Mm.
investors get taken very good care of because of the fact that, hey,
Mm.
they are not having to go out and do any heavy lifting, and they're able to benefit from your energy, background,
Mm.
knowledge. That's a great thing.
Yep. Yeah. And it's
So,
basically, again, it's passive for them. It's a truly passive venture compared to owning a rental, which I own rentals, but even owning rentals, not always passive.
not always passive. And you do get the upside, which on a mortgage, of course, the mortgage is not going up in value unless your workout with the
Mm.
borrower causes it to do that through your
Mhm.
modification, but otherwise it stays fixed and it pays down over time. So you've got this balancing act of
Mhm.
portfolio where you want to have your cake and eat it too. But definitely, if you have some undeployed funds that could go into something like this. Now, how long do your investors generally participate in the fund?
Yeah, 4 years. It's a 4 year, and reason it's structured that way is we try and get, it typically takes 18 to 24 months to do a full workout with a loan and then turn around and sell it back on the market. So we're targeting to get 2 full cycles of portfolios as we continue to grow and go within. But it is evergreen, so people can stay longer, but we require that 4 year lockup to give us time, because we've seen some funds where they do it in 12 months and you buy a non-performing loan and it doesn't pay you, and it still isn't paying after 12 months, or they're in bankruptcy or foreclosure, and the person can get their money out. It's, you didn't make anything. Then what happens?
Exactly. So there's lessons to learn for sure.
Mm.
And what do you see for the future?
I see lots of things for the future. So as a company, I think we're going to continue to grow and see opportunity. I think, and again, I'm a numbers guy. Historically, the number of defaults has been suppressed because of COVID and state intervention. I think we'll get back to norms. And when people look at, is there enough? Is there enough for you? The mortgage market is like 15 or 16 trillion dollars. And if there's a 3% default rate, so 3%, which, is below the norm, that's 480 billion with a B dollars in defaulted loans, which is out of 85 million homes, it's roughly 2.5 million homes. We get 150 assets in our portfolio, or we're trying to get 50 or 100 million. We're like a speck of sand on the beach for what we're attempting to do. And we're building more homes in this country. We're building more property. Values are going up. Every real estate is, even if values drop, the number of homes is going to constantly, we have more people are continuing to grow. So it's just the economy is still going to grow in that space. So we look at it as a excellent opportunity for people who are really trying to find an alternate compared to some of the other asset classes that are experiencing a lot of volatility.
Wonderful. So the folks that you're typically working with, have they purchased a portfolio themselves and now they're flipping that portfolio, or are you working directly with the original lenders?
So typically we're working with others who might have bought a portfolio, and let's take a $500 million fund. When they go to buy those assets, they're just buying, call it 500 of them. There's certain ones they want, that they put their A tranche. There's certain ones in the B, like, okay, do we have the capacity to manage these? And then here are the ones we don't want. And the ones they don't want isn't because they're bad assets. It's more of could be a state they don't like to be in, could be, oh, there's a higher chance of foreclosure or it's further default, that their bylaws don't allow them to hold those. So they'll go and sell those, as well as even some of their B tranche that are assets that we don't have the manpower to manage. So it's okay, who can step in and then buy a piece or a portion of this? Like tomorrow, it's a $70 million portfolio, and they anticipate that there's probably 5 of us who are going to take different tranches down of it. And we're hopefully going to be one of them. And these were assets that were on their books that they're trying to get rid of because they're trying to rebalance their portfolio.
There you go. So, are you able to go in and cherry pick, or they say, here it is, Chris, take it or leave it?
Yeah, these we can cherry pick. There was one 3 weeks ago, I'm sorry, a month or so ago that we bought that was all or none. So we bought that entire pool. It was 26 assets that, we went in, bought all of them. And there were 1 or 2 on there that really we didn't want, but to take down the entire pool, it's well worth it because we also got excellent pricing on that portfolio.
I'm very attracted to what you're doing, and I think you've got the tiger by the tail. Now, somebody that is coming in and investing with you and getting the 8 to 10% is how much do you expect to receive from them?
So our average investment's around 50,000, but the minimum is only 5,000.
Oh,
So,
wow. That's
and we see a lot of
incredible.
people with self-directed IRAs. The other thing that is, again, I think a differentiator and advantage is we can accept money from non-accredited investors. We went through what's called the Regulation A process that we had to submit everything to the SEC. All of our offering information is public information. Anyone can look it up. It's not like some hidden private placement memorandum that gets stuffed under a pillow somewhere. Everything's public. And so it allows us to raise money. And the jokes we have are the typical investor profile. We call them Henrys and goats. So the Henry is the high earning, not rich yet people who have good paying jobs and they don't have the time to really be an entrepreneur. So they are looking to invest in different options. And they're usually broad, diverse. They'll go some high risk stuff, some, more other types of options. And then the others we call the goats, getting old and tired. The people who had a real estate portfolio or have been tired landlords, they're getting close to retirement. And again, they want to be on the lazy river of, hey, look, I don't want something that's highly leveraged. I want something we have no leverage. So our money is backed by the real estate, and look at that standpoint of, I'm tired of dealing with tenants, termites, toilets, and which we don't have to deal with because we're the lender. If your roof leaks, you don't call your lender. We don't get phone calls when the roof leaks. Those
This
are
is
the
so
two
funny.
primary people we see.
I love this. I love this. Sometimes people call me a goat, but they're calling me the greatest of all time. And you're
Yep.
saying a goat is getting
Getting
old and
old and
tired.
tired. Yeah. So,
So I love that. That is so fun. And definitely, you've got those people out there in the world. And if they've got that full time job, they really don't have time to dig into the business. It's tough, it takes time. And if they can put money with a fund like you have, then it makes some sense to have that money locked down, tied up, used for the next 4 years and possibly continue to roll it. I've been borrowing money I've been in the business over 40 years and I've had private money lenders. And the funny thing about private money lenders is they don't want their money back. They put it with you and they leave it with you. And as
they want
long as
that interest.
the return on their investment, they're happy.
Yeah, and that's what we see with, again, the investors that come in is we're approaching we're 3+ years now into it. And people we've talked to, they just want to keep it in there because they don't want to go try and find a new investment. And also it's a low minimum compared to a multifamily deal that they might have to put $100,000 in. So it's lower barrier to entry. Plus, again, it's something that people may not have heard about this strategy, but it's easy to explain when you say, yes, we're a lender on your mortgage. If most people have bought a house that can invest, they've owned a house, they've gotten a loan through a bank. And when people ask, why do banks sell a loan? We always joke, have you ever had to call your bank just to get like a statement or anything? You probably spoke to 4 different people and it took 45 minutes. Imagine somebody who's behind on their payment trying to get it ahead of somebody and get through. Banks are very good at creating debt. They're not the best at managing it.
Amen. Amen. We bought a defaulted loan on a motel, and that guy that owned the motel had worked the bank over. They had done
Mhm.
modifications, they had done lowering the interest rate, they had done moratoriums on payments, they had done everything. And they
Mhm.
were sick and tired. They were just sick and tired of being sick and tired. And we were
Yep.
able to buy that defaulted
Mhm.
loan for $1 million. And we thought the guy would actually reinstate. He didn't,
Mhm.
and went into bankruptcy, the whole thing. And eventually we were the successful bidder on the courthouse steps and ended up with the motel. What
There
fun.
you go.
You never can tell how it's going to work, and definitely defaulted loans is
Mhm.
very intriguing, and there's always wonderful assets behind it. One
Mhm.
final thing I want to ask is we are certified affordable housing providers, and what we do is
Mhm.
help deserving families end up with home ownership
Mhm.
regardless of credit or financial background. And one of
Mhm.
the things we do is actually find the buyer before we even buy the asset. So,
Mhm.
is it possible that someone like ourselves could work with someone like you and actually be able to take any of those properties that end up being real estate owned, be able to put one of our potential buyers into a property like that?
Yeah, that would actually be a very plausible option. And this is one of the things I reach out to a lot of other realtors or people, affordable housing components or investors is everybody right now is trying to find housing. And I always joke, I'm like, you should be talking to the non-performing note guys because we know what's coming down the pipeline because we are the pipeline. We've got, for example, 11 properties right now in Tennessee, an area where the average home is probably 100 to $150,000 that we know we're going to be taking back. 2 of them we did, and we're in the process of renovating and getting it habitable because it needed some updates and stuff. But there's always lots of opportunities. And for us as investors, if we know we already have somebody on the back end who can come in there and take it, then that saves us so much headache and gives us the ability to basically really turn and burn on those assets versus trying to find a realtor, trying to list it, trying to stage it, trying to do all these other things where you can partner with somebody like that, it would be fantastic.
Let's do it. Let me tell you, one of the other aspects of our model is many of our buyers are willing to do some or all of the repairs to the properties. So they're
Hmm.
willing to come in and sweat
Hmm.
equity, and we give them credit towards their down payment for them,
Yep.
their willingness to do that. And we oversee that whole thing and everything, and actually work with them for years to build up their credit, build up their down payment. Until they can eventually get a new loan from the bank. So
Hmm.
that would be another thing, guys out there, seek out people like Chris that have these portfolios because that is another option for finding properties for your buyers. And I love what you have shared with us, Chris. Wow. So, how do people find you?
Yeah, they can go to our website, 7einvestments.com. That's the number 7, the letter E, investments.com. You can email me, Chris at 7E Investments. Also, find me on LinkedIn. I'm on LinkedIn a lot or some other social media sites. If you just Google Chris Seveney, it's not a very common name. There's only one other. And just if you're looking at the photos, just choose the good looking one because that will be me. And compared to my cousin, I've got a cousin with the same name. Outside of that, it's just us.
Oh, I love that. My friend, you have been awesome, and I sure do appreciate that. Now, any parting words that you want to share with folks that are learning what you do and how you do it, and what you would say to them?
Yeah, it's everything with investing is a marathon, not a sprint. That's the one thing I always recommend is be patient and don't try and hit the jackpot no matter what it is you're doing, whether you're an entrepreneur, whether you're investing passively, everything is going to take 3 times as long and cost 3 times as much as you anticipated. It's okay. And You will have struggles. It's not going to be easy no matter what it is you're doing, but just understand that tomorrow is a new day and keep focused, keep learning, and keep pushing.
Yeah, baby. That's one of my favorite things. Get with it and stick with it. Chris, you have been awesome and we sure do appreciate everything, your amazing wisdom and your background that you shared with us today. Thanks so much for being part of the whole enchilada of real estate investing. Thanks for tuning in to the whole enchilada of real estate investing. I hope you're feeling ready to take your investing game to the next level. If you're serious about building wealth, you won't want to miss the Millionaire Jumpstart. It's a 3-day live event that's perfect for any level of investor. Whether you're just getting started or you're looking to scale, this can be one of the final steps of making real wealth happen. So, what are you waiting for? Enroll now at millionairejumpstart.com and get ready to make big moves in your real estate journey. I'm Lou Brown. Until next time, keep hustling, and remember, it's not about how much you make, it's about how smart you play the game.